Having said that, today is February 14th, 2012. Today is the Options Tribe meeting. The Options Tribe, for those of you who have not been here before, is a free online webinar that SMB Capital holds almost every Tuesday at 5 p.m. Eastern Standard Time. And the idea behind the Options Tribe is that we try to bring great traders to the table every week to talk about what they do best, the types of options trades that they have found have been successful for them. That's the major purpose of the Options Tribe. We do have speakers in other categories now and then, but that's the major function of the Options Tribe, and so we hope that we're helping you to improve your trading game as an options trader through our Options Tribe webinars. You should feel free as a participant to ask questions at any time. I'm going to keep an eye on the chat as our presenter presents, and then I'll try to paraphrase your questions in a way that will be helpful, to everyone. So please don't hesitate to jump in and ask a question. There's a chat feature. You can all see each other's questions. Thanks to Charlie Ferguson, who reminded me to change that setting. And you can also see, your own answer or your own question. So we'll try to get those answered as efficiently as possible. Today on the Options Tribe, we have Andrew Faldy. And Andrew has been on the tribe before. He ran one of our most popular meetings a couple months ago, so he is officially back by popular demand. Andrew, welcome.
Thank you very much.
And today's subject is going to be using regression analysis for higher probability credit spreads. I think I know what that means, and I'm sure some of you mathematicians and statisticians out there know exactly what that means, but I am certainly very, very interested to find out exactly what that does mean. So we already have some chat activity here. Brad just saying, yeah, and Igor is saying what a tough life it is for you, Andrew, down there at 80 degrees. Brad said, no pink background today. No, I wasn't smart enough to do that, Brad. I should have. We did, if you go into Google, by the way, they have a little video you can watch, which is kind of cute. You know how sometimes on Google they'll put on I don't know if they do it, they don't do it every day, do they, Andrew?
Whenever it's a special occasion.
Yeah, special occasion they'll have some kind of video, so they've got a cute one on there today for anybody interested in watching that. I don't really know what it means, actually. I get a basic idea, but, whatever. So, okay, with that, I'm going to give you the presenter mode, Andrew. You can go ahead and start your presentation by hitting share your desktop whenever you're ready.
All right. I'll see which monitor this goes to.
Yeah, and by the way, Andrew, there might be some folks in the audience who did not hear your first presentation, so perhaps you could spend a minute or two just giving us a little background of yourself.
All right. My name is Andrew Faldy. I've worked with SMB a little bit. I spent time there last summer, 2011, working with Rick Martin. He is their systems trader. Learned a lot during that period of time, came back home, been studying further and developing things, staying in contact with SMB. I trade options for what is a family office or a very small hedge fund full-time, managing an account, a couple of different accounts. So full-time in this, been learning and developing systems and strategies. Kind of gray box. I don't let the computer trade for me, but I am very systemized, looking for signals and back testing, and that's kind of where I put most of my focus in instead of relying on fundamental analysis or speculation. So that's the background of how I've developed this core strategy. This is pretty much responsible for, I would say, 40 to 50% of our capital is a very similar analysis to this. I've kind of simplified it, and we use this in multiple ways, and I'll just kind of give an overview of the strategy.
That sounds great.
So
you're actually trading
yes.
this live in your fund. This is not theory.
Correct. This is the last presentation I did was theory, and maybe 10% of risk capital gets applied to similar things to that. This is much more practical. This is exactly what we do with the majority with the money.
That's interesting.
Big picture today,
this?
yeah.
Would you say you developed this technique on your own or with someone's assistance, or how did this come about?
Rick Martin at SMB taught me about regression, linear regression, and linear regression curves. Came back, and then that's been the backbone of all of my analysis. He is more into directional individual stocks and not the options necessarily, and my focus is more on options, so I've kind of reworked it, but using the same concepts of using the linear regression curve. So it's all based on what I learned at SMB, and then been experimenting and probably run 500,000 back tests since then, automatic, and kind of getting statistics and results and figuring out what has the best probabilities of working in the future.
Through TradeStation, is that
Yes,
how you were able to do so many?
Yep.
You weren't sitting there doing them manually then.
No, exactly. That's actually why I went there, because doing it by hand, it would take me a month and a half sitting at the computer with an Excel sheet and maybe a piece of graph paper just to test the last 3 months of a certain strategy a couple different ways. And now I can test the last 10, 20, or 50 years of an index on the hourly chart, going back a certain period of time, and I can test and optimize 30 different variations of the last 10 years, and the whole test takes about 30, 45 seconds. So it's a much better way to do things, gives me a lot more confidence in moving forward and taking the trades as the signals come up.
TradeStation is absolutely phenomenal when you
Yes.
see it. When you see what you just said, which I've seen a couple of times, I can't believe it. Igor, by the way, says, I think he's referring to regression analysis as the secret sauce. I don't know that that's the secret sauce, but that's a reference to Rick Martin and his secret sauce. So anyway.
Okay, good.
Yeah. All right, so fire away, Andrew.
All right, so here's the big picture outline or pathway that I'm going to try to take and stick with today. First, we'll define what linear regression is and regression curves, and compare those to moving averages. We'll discuss the different ways to use it. The way I was initially taught and shown the value of it was for trend following, and then also developed contrarian trading methods with it, specifically with options. And then go over a specific trading plan for using a regression curve for selling verticals on the SPDR or the SPX, whichever is your preference.
Sounds great.
What is linear regression? Here's a complex explanation. This would be the actual formula and graphing of what linear regression is. And as I look at it, I could probably explain about 25% of that, and probably not even accurately. So the point here is this is not important. We don't need to know exactly the math behind it, but we can know this is not just a markets tool. This is a general math tool. You can see it in any kind of statistics or analyzing what appears to be random placements, but the math behind it is a little complex, but it is a valid tool that is used in all types of mathematics. Simple explanation is it is a straight line through a set of what quote-unquote appears to be a random set of values. So here we have a lot of blue dots which appear to be randomly placed, but they have a trend to them, and the red line is a linear regression line, and that is intended to plot the absolute straight line middle of all of those values as they go along in time or go along in number from -20 to 60. So that is the simple explanation of what linear regression is. It's just the center of what can appear to be random values.
Okay.
These are all available in platforms. I'm going to use thinkorswim actually to show you these, just to show that any platform, I think, stockcharts.com or whatever the name of that one is, and thinkorswim, and I think even Google Finance, it's a very common technical analysis tool, so we'll just go over how to put that on there and how to compare it. So we'll draw a linear regression line we will add channels to that, which measures the standard deviation. We'll connect the ends to create what is the linear regression curve. And then we'll compare the linear regression to the moving average. So I'm going to pull up Thinkorswim chart, because I believe it's very popular with options traders, so it'll be good.
Yes, I would say, my observation, they may have 75% market share of options traders.
Yeah. So we'll use that. That's actually the platform I use for trading. I use TradeStation for all my studies and my indicators, but I do actually trade through Thinkorswim. So I'll try to go slow just so you see what I'm putting on here, and then maybe you can do it yourself. When you click on drawings, you know, I'm sure most people use the trend line and price levels, but just down a couple more is the regression line. And we saw with the blue line, we can do that with on this chart. We can click the beginning of one point and go to another point, and we can put the middle of, and it uses the close. So it's going to be the middle of all the closes. So I'll just kind of pick a high here, and I will click it once. Now I'm going to move my mouse around. Up in this corner here, you're going to see where it says bars and the number of bars. So the best number I've come up with is somewhere between 20 and 30 for most backtesting. Is the most consistent number. So I'll use 20. I can't hold my mouse up there and show you, but if you look up in the left-hand corner, you can see that I've moved my mouse over 20 bars from the start point. And I can click again, and this is the middle of the last 20 bars. You can see it, the high and the low, and right through the middle. That's what that linear regression line looks like. And that was starting on this day. Let's see, this is in the next step, because I almost got out of order here. All right, below that is a regression channel. And I will click on that first day again, come back to here again. The line in the middle is the same. The lines on the outside, and since you're options traders, I don't need to probably explain too much what standard deviations are, but that is a one standard deviation move from the middle. So we can, from this point, see that 68% or whatever the exact number is of price is within this amount. So in a highly, and this obviously back in August, September last year was a very volatile market, so that was a very wide curve. And if you come to closer to today, I'm going to match it up to 20. So the last 20 days, the range of the market or the volatility is a lot narrower. So that is the trend of the last, or the middle line of the last, or not the last 20 days, but the 20 days during this period. And then 68%, and actually in this case more of it because it was very low volatility, seems to be, stayed within that channel.
All right, Andrew, we're getting a couple questions in here.
All right.
Could Andrew discuss the difference between the regression channel in, quote, drawings, unquote, versus regression channel in the studies? Now, I'm not sure what he means. Maybe you do.
Yep, we'll stick that in there and see what there's a few different things. This one, so if you do 50, I believe what happens, and he can stop me anytime if I'm clicking on the wrong one. If I click it, I believe it will automatically just grab the last 50. Doesn't look like it. That's a lot more than 50. So this is going back some period of time automatically. I've only used 20. This seems to be going back farther, but it's going to be the same thing. As you see, if I click and drag all the way across, it starts to match up. It looks like it's actually doing all the data I have on the chart. Yes. So if you go back, all the data you have on your chart, that one's coming on. I'm not sure exactly what the 50 means. So that's, am I answering the question or not answering it? Or
Well, he'll have to,
yeah.
have to say. Yes, Ralph said thanks. So basically, what we're seeing, the middle line is the actual regression line, and then the two straddling it are, or strangling it, I guess we'd say, option terminology, are the standard deviations on either end, on either side of that?
Yes.
Okay, one standard deviation.
Let's
Okay.
see, and I'm going to just see if that is exactly at standard. I don't see the number, but I believe, and visually on this one, it does look like a 1 standard deviation.
Okay.
All right, so that's the nuts and bolts behind it. Now here's what I actually, that's the linear regression line. So that is a single line drawn, and I'm going to do this again now, but I'm going to draw a few of them in a row and then begin to connect them. So here's my first one, and I'm going to go over 20 bars. So I've hit 20 there, and I'm going to go to the next day, and I'm going to make another one.
Okay.
So here what we can see is the first set of 20 days we have, and actually it's fortunate, I was trying to grab one and I did, where this is showing a down trend, where these 20 bars line up to create a linear regression that is sloping downward. Right. The very next day, enough of the information dropped off and new information was added so that the middle of those 20 days actually was starting to point upward. So that's where we're getting into, we can track specific linear regression and then the change of the linear regression. And that is a linear regression curve. So all you have to do is add a study, type in linear or click L or just drag to it, but linear regression curve. And over here, because I'm measuring 20 days, I change the setting to 20. I apply it, and we can see right there that on this day, it connects to that line, and on the next day, it's connecting here. So the linear regression curve is connecting the ends. So I'll go forward a few more days just to prove that that's what it's doing. So go to 20. So that's 20 bars from the first day I clicked, and there you can see it's following that curve. So this, first we got to know what the straight line is. That's why we're looking at it. It's the middle of what can appear to be random information. And now the curve is telling us the trend of that line. So we can see here that the trend is moving upward. And in this period of time, the trend of, not price necessarily, but of the regression curve, or regression line, is shifting downward.
Okay.
So let's see, I think that's, and the one other thing I'm going to do. This line, this green line, the curve, is using 20 candles of information. So this point right here and this point right here is using the last 20 candles to come up with its location. I want to compare this to a moving average. So here's a 20 candle moving average, and I'm going to change the color so we can make it red because it's the opposite. So you can see in this time frame, if you're following this linear regression curve, it starts sloping up while the 20-day average is still flat. It rides up, and while the 20-day is still rising, the linear regression is using the last 20 candles to say, actually, this is more of a down slope, flat during this time, but sloping. So here we're getting downward indication where the 20 is still looking upward. So it's using the same number of candles, but coming up with something that fits price a lot closer. So that's it on the chart. That's, it's not some secret formula or, some algorithm that has to be built. It's right on the chart. Everybody has it available in any platform they have. It's just a simple way of putting in the middle of the chart.
So is it always going to be more accurate than the moving average?
It will always be closer to the price.
So is it a better predictor of direction?
I believe so. And here's the two, the comparison. Let's do one at a time. Moving averages look backwards. It's saying what was the middle of the last 20 candles. If you add them all up and divide them by the number of them, what is the middle? So in this point in time here, the last 20 candles, the middle price is here. The regression, however, says this is sloping. It's 20 candles. The last 20 candles are sloping upward. So this is what the middle of all prices are. This is the middle of the direction, which is what I'm putting in here. Linear regression uses that same data to point forward. It's telling you what the price is doing, whereas moving averages are saying what they were or where price has been.
Okay.
So that's the two main differences between linear regression and moving averages. Did I see? I think I saw pop-ups that questions were coming in. Are they anything we need to read?
There's two. One is from Nagaraj, who's asking why 20 candles, and Igor is saying that's an SMA. That's a question.
Yes, simple moving average is what I'm comparing it to. Exponential will be a little faster, but it will still be, it'll be somewhere between the two, typically.
Okay. And Nagaraj is asking why 20.
Yeah. 20 is, Rick has a more detailed and elegant way of putting it, but basically price patterns historically where you get waves. So, you know, it goes up and it retraces, it goes up and it retraces. Those waves, more often than any other number, happen in 20 candle increments. And that happens either if it's a daily or an hourly candle you're looking at. So in this, I'm just going to randomly pick one. So here's a bottom. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Not perfect, but more often than any other number, more often than 50 or 10, you'll see that price typically has a swing of 20 days. Now, if we just look at the small amount of information on this chart, you're going to find multiple examples of how that's not true. But over the last 50, 60 years, over multiple markets, commodities, equities, interest rates, anything, if you're going to pick the most common number that shows waves, it will be 20. Also in backtesting, it is a very robust number. So if I say, you know, when it's going up with 20 and when it's going down with 20, or if I'm going to be a contrarian and say when it's above 20 or below 20, that and 30. Some markets, it's based on, not based on, but sometimes the beta, a lower beta of 30 works a little better, higher beta 20 works a little better. So that's why I came up with it. It's just what happens to work over the most number of markets over the longest period of time.
I see.
And then, let's see. All right. What can we do with this line? Mean reversion and trend following. In the mean reversion world, we can sell call verticals when price is above the line, because that we know is price is above the middle of the trend. So it's relatively high. So we can say that's a good opportunity to sell call verticals. Obviously, and then the opposite, sell put verticals below.
Are you saying above
Yes.
the actual linear regression line or above the one standard deviation point?
In this one, above the actual line,
Right.
and I do use a distance typically, and I'll show that a little later. It depends on how aggressive you want to be or how often you want to leg in. The most robust is about, not most robust, but equal, you know, giving you enough opportunities to be in the market every week or so. 1 or 2 average true range, so ATRs, 1 or 2 ATRs above this line is a good point to leg in, and 1 or 2 ATRs. So here's, you know, I don't know exactly what the ATR is here, but you can see 2 days below, where, you know, we got 2 days of downward momentum below the line. That is a good point to sell. Here we get one big up day, but here we get a couple of up days starting to show that it's about 2 candles above. That's a good point to leg into call verticals.
All right, let's do something real quickly. We're getting some comments about sound. Can folks please tell me if you're clearly hearing this? Maybe 4 or 5 people say yes or no, and then we'll. There's 1, 2, 3. Okay, fine. Okay, sounds like it might must be local to just a couple people. Okay, thank you, folks. We're good. We're good. Now,
All right.
we're getting questions in. You know, it's obviously a knowledgeable options group here as to what delta entries. If I understand you correctly, and you may be going into this shortly, in which case we'll just be quiet and wait for you to present it.
Yes, we will come back to that.
Okay, as to kind of how you handle the entries, where you enter, and so forth.
Yes.
Okay.
Yep.
So I suspect that. So, folks, let's wait, and that looks like it's coming as far as how he handles an entry. So you're saying when you're either above or below the linear regression line for a couple of days, that's proven to be pretty good entry point.
Yes, and I have backtesting results on that coming very soon. All right. So in general, though, mean reversion, it's best you wait till we're above or you wait till we're below, and also low beta. This is, it's not any good to do this on Apple just because we're above the line to go sell call vertical. So this would be low beta or indexes that we would look at that. Trend following, when the line is moving upward. So if today's linear regression curve point, the number that is representing that value today is higher than it was yesterday, you can look for long trading opportunities. Or the opposite when it's going down. Very important here with additional criteria. So if you're a tape reader, you're going to look for a level to trade off of. If you are going to just want signals, you're going to want something else, either indicating the shorter term trend is matching the longer term trend, or momentum is rising, or some other indicator that you like and are comfortable with. On its own, especially with indexes, it does not work just to go long short every time the line changes. You'll want to trade that, but it does help filter if people, say, I try to only trade with the trend, and sometimes the trend is not clear. For example, maybe in this time frame, if you're looking maybe on this day, well, it looks like we're going up, but it's below this. So some people say, well, is that an uptrend or a downtrend? This line here simply says we are now in an uptrend. So you would possibly look for upward momentum signals to trade off of. So it helps have a single way to answer the question, which direction is the trend, so I know which way to be looking for trades. Try to skip through quick. All right. So running a backtest, this is for the contrarian trade. Here are some results for a backtest on the spider. So this is if we are 1 ATR below the 20-day, and then somebody can type in if they need to know what ATR is. Probably most people do. If not, we can go over it quickly. But if we're 1 ATR below the 20-day linear regression curve, you buy. When we get back to the curve, you sell. If we're 1 ATR above the curve, we sell short. And when we get back to the 20-day, we cover. The 10-year backtest results, and that's not the biggest chart, but that is the profit and loss curve of that strategy over the last, and I did longer. How long is that? 1993. So, is it 20 years? Yeah,
19 or 20 years. Yeah.
So 19 years. So over the last 19 years, that has a positive return over time. A lot of times, you hear you can't buy the dips all the time. Like in 2008, that wouldn't have worked very well. In this, it's waiting till we're a certain distance down to enter the position, and there are periods like this period of time it's not doing very well because this is probably a downturn in the market where you're buying low and covering lower. But in general, over the last 20 years, what this is intended to represent is that at that point, I think I have the number, I just can't remember exactly what it was. Yes, 70% of the time, it makes a profit. This is a directional trade. This is not options. This is if you actually short the index or the ETF, or buy the ETF from that level and cover and sell when it gets back to the center. All this is intended to represent is this is 70% accurate that when it's at that level, when it's ATR, 1 ATR below or 1 ATR above, there's a 70% chance that there will be a better price for you to sell a different vertical, to sell the opposite side. So that is the purpose of this backtest. It's not the strat. I don't go long short at that level. I use those levels to now know that I have a higher probability of legging into 1/2 of an iron condor, and that when we get back to the middle, I'll be able to put on some or all of the other side and probably have a better price so that both halves of the iron condor are filled at higher values than if I just put it on one iron condor today.
Mm-hmm.
So
when you say 70%
yes.
accurate using stock, Andrew, are you saying ignoring options? If you
yes.
simply bought at the buy signal and sold at the sell signal.
Yes, exactly.
70% accurate, okay?
Yes. So with options, with credit spreads, theoretically it should be even better. So if we're using something with, that's implied probability or the delta or whatever we're discussing it as, if it's a 25 or 30 delta, that alone is saying it has a 20 to 30% chance of success. Then we get into it at a point where we say, well, this one, I have a 70% chance of it moving away from this price so that I can go put the other side on at when that delta is then higher. So then I'm getting the same return on risk, but I'm taking an iron condor now that covers more area of the market. And
Ed Dalton
someday,
is
yes.
asking, how many day average true range value are you using?
I use the standard setting of 14 when I do it. Sometimes I put on 20. It's usually close enough to the same. But okay. I would actually have to go back. Actually, I think I have it open. Let's see. I'm just going to pull up the code real quick and find out what I have in there. Actually, on that one, I have it set to the same length as the regression curve, so it's 20.
20 days.
In that test, it was 20 days.
So it's interesting. So you use the average true range. It's sort of when it has strayed an average true range away, then that becomes the signal.
Yes.
Okay.
You get more signals that way. If you use standard deviation, you get less, but I'm trying to get in.
Right.
So if I wanted more accurate signals, I could probably use standard deviation where that channel really widens out.
Right.
But then I'm going to probably have half as many signals. So I'm just looking for it's relatively high so I can sell a call vertical, or it's relatively low to the trend so I can sell the put vertical. As we saw when I had the moving average on there, if you're waiting until it gets below the 20-day, you haven't been selling put spreads for a while, and that's what you want to have in this market, is you want to be legging into that put side. And some people are having trouble. It's easy when we have a couple of big up days. You think, I'm going to go ahead and sell up here at 140. I'm getting good credits. It's above resistance. But then when are we getting the other side on? It's hard sometimes to find, well, what's low? Well, I can't predict or assume the market will drop rapidly at some point where I could put on the other side. So I just have to say it's relatively low compared to the trend. I can put some of the other side on. So this, and you kind of saw a little bit, this is the chart that I look at, so I don't even have to do the math. I just see when it's happening. Also, this is when the back test occurred. These are the trades. This is in a similar time frame as when I was drawing the lines on Thinkorswim, but here I have everything actually plotted. The middle line is linear regression curve. I have it so it changes to blue when it's going up and yellow. Unfortunately, I got to figure out how to change that, but because from this day, oh, I lost it. From this day to this day was down. Unfortunately, plots the next day is yellow because yesterday was down. But either way, you can see that when it's in a downtrend, it's yellow. Uptrend, it's blue. And then in the gray area, I have one ATR or two ATRs. Sometimes I vary. I have to check that. I have to double check that. I may have misspoken on the number of ATRs here, but I will. You know what? I'll just pull it up again. Actually, the next slide has it, so I'll just wait till then. So here, when it gets to the buy signal, which here it happens to gap way below it, that is a buy signal, or in our world will be a sell put spread signal. When we get back to the middle, that is the signal to sell in the directional test, or in this, it is the signal to balance my credit spread. So then I will come in and sell some of the call side and wait to see if it gets all the way up here to sell even more of them. So here it's...
So once you return to linear, if you're doing, it's almost like a legging in condor strategy, but
yes.
It sounds like when you get to the linear regression line, once you've, in this example, sold your put spread, you get up to your linear regression line and you sell some but not all of your call spread.
Yes.
And then you'll take a wait and see attitude about selling the rest of it.
Correct.
That's interesting.
And actually, the very specific way I do it is I sell. To me, it feels like a lot because the number keeps growing every month. But I feel like I have a lot of verticals to get into over the course of 30 to 60 days. So I just usually do about 20 to 30% at a time. So every time I get a signal, I just put in about 20% of my risk.
All right.
So here would be 20, here would be 20, here would be another 20, here would be another 20, like that, and then I just keep legging in until I got all the positions on.
Wow.
So here is the trading plan. Sell call verticals at the top, put verticals at the bottom. I use these.
Andrew.
Yes,
Greg,
yes,
well,
yes.
I got a feeling we're kind of going to answer the question you're asking now. If not, we'll ask it. So go ahead.
Okay. And then I use the center of the channel. So if we're right in the middle, and I feel like my deltas are way too bullish or way too, that's my portfolio, not the position of the contracts, but my portfolio delta. If that's too bullish or too bearish, I will use that time to say, hey, we're really actually in the middle. So I'll balance that out to just be leaning in the direction of the trend in case I happen to be too optimistic or too contrarian. I use that opportunity to balance a little bit. This is, to pick one, this might be better for most people, is 50% of your risk at a time. So on that first signal, you put in half of your puts risk.
Right.
When you get to the middle, you put on half of your call risk. And then you wait till the next signal to put on the other half of that side. And then you wait till it gets back to the middle to put on the last half of the other side. So I know this group can probably get what I just said. Most people may not think I just made any sense, but that's a simple way to put it. I sell at the 25 delta more or less. That's one criteria. Second criteria is I want it beyond support or resistance. So if, like recently with the VIX being relatively low, some of these options out 30 days, the 25 delta is not paying me 25% return on risk, and it's not below a support I'm comfortable with. I go out to another month. So both of those criteria need to be met, that it's around the 25 delta and beyond a significant level, that it has to break that level before I go in the money so that I don't have concern about it until it breaks that level.
And you'll actually go to an out month, if necessary.
Yes, I go out as far as necessary. Actually, that's something, I'll show that at the end, but in income trading I found, 60 days or 40 days or 30 days out of the money. It's not the same on butterflies, but out of the money verticals have a very similar time decay at 60 days as they do at 30 days. So I would rather go out and get that better return on risk, and that's actually the next slide I'm going to show too. So 25% return on risk minimum. I very, very rarely will eat into that number. More often than not, I actually push it up to 30 or even higher than 30. 30 to 60 days.
Return on risk for any new credit spread you put on, or
For any new vertical.
For any
Yes.
new vertical, you've got to have a minimum 25% return.
Yeah. So it'd be a 20
at
cent.
25 delta and beyond support and resistance.
Yes.
So you've got a lot of criteria here. Okay.
Yes. So it's
Good.
not just blindly what delta or anything like that. Several things I look at to make sure it's something I'm comfortable with.
Okay.
And anywhere from 30 to 60 days to make sure all those criteria are met.
So you won't come in any earlier than 30 days, or any sort of later than 30 days, or any earlier than 60, generally speaking?
No, I'll pretty much be, everything will already be in the market before 30 days comes. And then on this next point you see, when at that point, as I get more signals, I actually use that to start taking things off.
Right.
So if I have all of my positions on, and we're less than 30 days, a lot of time has passed for some of these things. So if something's at a 75% win or 80% win, or the spread itself is only 5-6 cents, or the short is down to 5 cents, and here I wrote 10 days, but really I start looking any time before that, because I've had this happen many times, especially in last August, September. I would sell a call spread, the market would plummet 8% or so, or 3% or 4% in a couple of days. Right. That spread would be worthless. So I closed it, and then it would run back up, and I got to sell it again. So I'm always looking for the opportunity to take profits off, so I might have the opportunity. So if I put something on at 60 days out, 20, 30 days goes by, I've closed that one, then the market runs back in that direction, I may have an opportunity to actually collect 2 credits in that from that spread.
Right, you can resell that side. So
yep.
You use additional, when you indicate that something is a 75% winner, do you mean you have shrunk its credits, the market has shrunk the credit spread down to 25% of its original value?
Yes.
Okay.
So if a 25-cent spread is down to 5 cents, I will be staring at that every day to see where I might be able to get out of that one.
I see.
So if we're way up above the line and something dropped to 5 cents, and I already have all of my spreads on that side, I'm pulling those off very, very rapidly, so that if we pull back down and I can resell something a little higher than that for a new 25 cents, then I'll have the opportunity to do that. But it's no good to me to see there's 5 cents left, and I'm going to wait 20 more days to collect 5 cents, or I can buy it back for 5 cents. It drops down, and I can now have 25 cents, so now I get 20 cents extra instead of waiting just for the 5 cents.
Right, and another way to drive that point home is, why would you wait, all that time for that additional 5% when you're risking 100%? It made sense because there's no law that says you can't not only give back all that profit, but then start to eat into your capital.
Exactly.
So you have a lot to protect and very, very little to gain.
Yes. It took a long time for that to sink in for me, but after I did it a few times and I realized how much extra I got because I was willing to take off that small amount that was left to be made,
right,
because I was able to put that position back on.
Right.
That's when I fell in love with that concept, and I've never looked back. So I encourage anybody out there that struggles with that, look back at things that either was a winner and turned into a loss, or that was tying up margin for 30 days,
right,
and how much money did that actually make you compared to the new opportunities that showed up where you could have reused that margin. So kind of go back and look at those opportunities. And then here it is. We already said it, but reopen the winners. So if you can take one off and you can put it back on, you could possibly get 2 credits. Or I figured out after commissions, after you pay for the one, and after you put it back on, you really only get about half of another credit, but you get more than the original. A note on risk reward. So this is visually, and I have this actually right above my coffee maker, so every day I actually see these, something similar. It's not this one specifically. I made it look a little nicer than the one I look at every day. But this is when you sell a 10 delta or a spread where you get 10 cents. This is what your 10 cents looks like right here.
Right.
And this is what your 90 cents of risk looks like. If you sell the other side, so here this is vertical and iron condor. So if you sell the other side, this is now your 20 cents on your, and this is the original risk because you're not in it yet. This is the original risk you took, and this is when you finally get both sides, this is what you fought for. When you get verticals with 20% return on risk, it grows rapidly. First of all, the red comes down and the green comes up.
Good point.
And here's the 30%.
A smaller number also. That's interesting.
Yes.
Right.
Yes.
Right.
That's this. So many. One of the other guys I work with, his thing all along is, but it has a higher probability. Well, it also has a much worse downside. We kept talking about it's only 10 more cents. It's not just 10 more cents. It's 10 more cents of reward and 10 less cents of loss.
Of risk, right.
So it is a 20-cent difference, not a 10-cent difference. Then when you get the other side on, now you have 40 cents on 80-cent risk, not 20 to 90. So that's a 70-cent difference. And this one here is a 40. That's a 30-cent or 30% difference in what could happen to your profit and loss in your account, because you were trying to do something, quote unquote, that was higher probability.
Yep.
And then this is what I really push for in most of mine, because when you actually get both sides on, you're really getting close to getting into the world where you can't really, if you're legging in methodically, you can't really get into a position where something really bad can happen. Because I've got both of these sides on. That was my original risk. And in reality, now that both sides are on, I actually can only lose 40 cents because I've collected 60. So I'm to the point now where nothing, if I leg into these at what I feel is a statistically good place to put something on, and I get the other side on at a little better credit than if I had put them both on at the same time, nothing really bad can happen compared to all the times they do work out. Here you have to have 9 good months just to get back to break even if this is what you're trying to accomplish. So the first half of last year looked great. August comes, all that works down the drain. It's very difficult to hop back into the market. You're afraid it's going to crash at that point. Whereas if these are your risk rewards, that's not that bad of a month. And also, we might look at that a little later, is you get into trend following with the signal too, and you're hedged in the direction of the trend long term, then it's even less risk. So kind of the weightings I feel like you should put on the certain risk reward.
Well, taking this out to its logical conclusion, the butterfly, an iron butterfly, would be the ultimate. We get a double check, right? Because you're getting
yes.
In many cases you'll get a credit which will be greater than your risk.
Yes.
Right.
With the iron butterfly, because the verticals are so wide, it does tie up a lot more margin just to have one side on. So you could look at that legging in that way and doing wider things closer to the money, but no matter what, it comes down to risk reward. You're collecting a lot of credit because you're at the money compared to your risk.
Right.
So I think that definitely could work if you're not uncomfortable with tying up the margin on just one half at a time. Weighing expectations. Challenges. It is hard to sell against your opinion. I'm on Twitter. I put on my blog post, and then occasionally, I'll say I legged into a put spread today. And I'll put up the chart. It was a day kind of like this one, or, where looks like we're up, we've hit resistance, it's pulled back to here, and, based on this candle, you saw at some point it was actually a big red candle. So I'm looking at this big red candle. I do some tape reading too, just to make sure the market isn't just really accelerating through a certain point. If I feel like it's down to a certain level, it's here, this is the point where I'm supposed to be getting in, and I say legging into put spreads at 125. So because it's down here below, I don't know exactly what the number was. I'm assuming I could get something good here 125 out in March or February at this point. But so many people feel like we're going to roll over and this thing's going to crash. That's just absolute suicide to be selling anything at that level. So that's one of the challenges of this, is it's very hard to sell against your opinion. If you think the market's going to go up and we're just a little bit above this line and you're selling call verticals, it's hard to do that if you're really bullish.
Right.
And also with this, there's no home runs. So we're not looking to buy something that's going to go up big time. We're really just collecting a small or a medium-sized return on risk. But I think everybody in this group knows all about that with credit spreads. Benefits, especially using linear regression versus moving average, is it respects the trend. So as the market moves up, it used to be, before I learned about this, I would wait till the market was quote-unquote up, and I didn't know what that meant. So I would just look for it to, so maybe in this time frame, 2 big up days. So I'd say, okay, we're up. So I would sell a call vertical.
Right.
But I didn't have a reference of up compared to what? Up compared to this day, definitely. Up compared to this, it's not. But here, now I have a reference point. Here, when the market just isn't, it just keeps going up and it's not pulling back, and somebody say, well, if we get maybe down to 125, during this whole time frame, I'll wait to put on my put verticals until we're down at 125. Well, that's predicting. If we know from this point here that it's going to go to 125, I don't know why we're just waiting to sell put verticals. We should be short the market. But we don't know that. But what does happen is that market will move in waves over the direction of time in the direction of the trend. So if you're waiting to get below the 20-day moving average, not necessarily going to happen. So this method and this indicator respects the trend because it will say trend is up, we're just below the trend line. And sometimes it happens when we just move sideways for a while. And that's a little hard to do. This is a big, if we just stare at that one candle, I went too far. Say now we're below the line.
Right.
And now, okay, big, nice up day. Maybe it's high enough, maybe it's not high enough to get in. Maybe at the top of this candle it was. So we sell some call verticals. And we say, okay, now it should get down to this level. So we can put on some put verticals. But all that happens is it goes sideways. And now it's here. And we're getting a signal to sell put verticals. Well, it can drop all the way down here. It's hard sometimes to put those on, but it will tell you, hey, this is sideways consolidation. Overall momentum is still up. Other benefit is it's consistent, and to me, it's made it a lot less stressful to know when I should be getting in, when I should get out, because of that profit loss curve I showed you over the last 20 years. I have positive expectation that I will have a better price. If I put this one on now, I have a pretty good chance. First of all, it's below the next level. I've waited till we were at we moved in that direction a little bit to put it on. It has its own probability because it's a 25 delta or 25% probability of expiring. And I also have that information directionally speaking that I probably will have a better opportunity. Knowing that, having all that historical information makes it less stressful to know, yes, I can put this one on and I can wait to put the other side on. Any questions come through recently?
We did. Do you ever reference the VIX to justify selling premiums?
Yes. I need to look at that more often. Sometimes I get caught a little bit, like I was very short Vega, which actually you can see right here we're going to talk about Greeks. But what will happen is if the VIX is low and my Vega is very negative,
right,
I might figure out a way to put on a calendar instead or do some other things. But in general, yes, it's going to be better to sell when the VIX is high, but I'm trying to make money every month and every week for that matter. So I can't just depend on that to spike before I get into credit spreads. But I do use calendars and diagonals with other portions of the account for the trend following and Vega balancing.
All right. We've got a bunch of questions, and I'm having a thought, Andrew.
Okay. Mm-hmm.
It's getting to be 6. Now, you've got how many slides coming up?
1. This is the last one.
1. All right, because, all right, that's fine.
I'll go quickly through it, too.
Yeah,
I'll just throw it all on there.
That's not actually where I was going.
Okay.
The next week, we actually were not going to have an Options Tribe meeting because I'm being interviewed at the Trader Expo, and the timing would make it impossible to have an Options Tribe meeting that I'd be hosting. Now, this is really putting you on the spot, and it may be impossible, to do this. But I'm wondering, we've seen sort of, this has been all theory so far, and it's fantastic. I mean, it's amazing. One of the best presentations I think we've had as far as giving the framework. And I'm guessing, knowing this group, that everyone's dying to see, an example of how you actually traded or could have traded a period of time. Now, I don't know if that's just way too much to pull something like that together by next week. And, we should probably be talking about this offline, but I could definitely work with you during the week to get into, do you have OptionView or some other backtesting?
I had the trial, but I have not learned it as well as I should have.
Because you
so
and
far.
I could get together and actually, run through an example where you'd say, maybe we'll even pick an index you haven't traded or something, and say, okay, if the linear regression line had said this at that point in time, I would have sold half of my credit spreads that I was planning to trade that month at this point, and so forth, and then kind of run through an example. Would that be hard to do?
Yeah, not at all. I'm going out of town Thursday through Monday. I'll be back Monday night, but I can give you a series of trades. So I can give you the date and the price or something, and give you a series of trades. And then if you can put them together and give me screenshots or something, then we could be all set.
Well, that'd be fantastic, folks. Would you like that? Ed's saying that's what I thought. I think we're dying for an example here. Yeah. So here's what I'm thinking. Maybe should we just stop now and have you start next session by, I'll give you the WebEx passwords and everything, and you can actually open up this. This is if you wish to do this. I know I'm putting you on the spot, but open up the session, or I'll get Ho-Shang, to work with you. Open up the session. Go through the rest of it. WebEx is really easy to use, and then the only thing is, I'm thinking screenshots would be more cumbersome than actually working through OptionView with it. We can talk about this over the next day or two. But I'm thinking, as long as the iron's hot, everyone's kind of into this and sort of watching it. Then I think we. Brad's saying if you need help running it with Andrew, let me know. Oh, that's an idea. So maybe
Brad, somebody else knows.
Yeah, well, Brad's you've got OptionView, right, Brad, or OptionNet? Either one would do it. Yeah, so maybe you and Brad. Yeah, he's got OptionView. Okay, good. So then maybe you two guys could run the session next week.
Sounds good to me.
Together. Yeah, that would be awesome. Okay, great. So why don't we do that? How does that sound, everybody? I think that'd be. In fact, I'm going to be jealous because I'm going to miss it. But I'll watch.
That's why there's recordings.
Yes, exactly. Okay, great. So next time we'll actually go through. What do you think is going to be easier? An actual month that you've traded, or or would it be better to do like a hypothetical?
Yeah. I'll just pick a period of time that would work.
Good. And then I think what you'll have to do is keep alternating between the regression line graph and then the decision you made on the option side.
Yes.
So that that's, I guess, the key to the whole thing, right? To kind of see how your theory drove the decision making process.
Yep.
So yeah, I think that's the way to go. So that's awesome. Okay, great. So there will be an options tribe meeting next week. I'm going to just pull back the desktop at this point, Andrew.
Let me do one thing real quick before you do that.
I'm sorry. Okay.
Here, if anybody wants to write these down, if you have questions. Like I said, I do this full time, so I enjoy the interaction and when people have interest and have other ideas. So email, Twitter, and blog. So you can contact me and ask me any questions you want.
Yeah, do that. Last time we got a lot of good follow-up to Andrew, and he was great about responding to everybody. So please take him up on that. Please take him up on that idea. And Chris Stockton's saying last slide. What, Chris? Does he want? Are you saying
I skipped over the last one, so if I can.
Okay, well, go ahead then.
There it is. I'll go through it quick. This is, in general, this is how I manage my Greeks, which is another webinar. So we can go over that some other time. But I always kick myself. Whenever I get away from this, it always bites me. So I am very into this, and I'm trying to become more and more disciplined in that. So I would encourage other people to consider this too. With the Greeks, these are what I try to accomplish as I add things. So this will go into my decision making on what positions I need to add. So with my delta on the credit spreads, so this low beta or spider or anything else, the delta will be contrarian to recent momentum. So if we're up and above the curve, my delta on that will be slightly negative. Okay. If we're below the curve, it'll be slightly positive. So that's something I always have to look at. I also do a long-short high beta portfolio. My favorite lately has been FAS because it actually trades like an index because it's the financial industry, but it has the movement of something, like a single stock. So that's one of the types of things I trade. That I trade in the direction of the spider trend. So if the spider longer term is going up, I will look for things to buy that have higher beta, and then those will be in the direction of the trend. And then total account beta weighted, and I can answer that for somebody that doesn't know what that means, but if it's beta weighted, overall I try to keep my delta very low, very comfortable, so that any movement in a certain day that is different than I think it's going to be, or runs a little farther down than it has, or than the normal movement, it's not going to hurt that much. So it's very low delta, but I try to have it leaning in the direction of the trend. So lately, if we're below the line, it's up. If it's above the line, it's kind of flat. So it's kind of leaning in the direction of the trend. All right. Gamma is short. That we'll have to go over later. If you know what this means, it's short gamma. Right. That's your index. That's income. And expanding gamma is my higher beta long short stuff. And that becomes the hedge for last August, last September, is I have some of those positions on that are going to grow in value as it continues in one direction. Theta, obviously your income stuff is high and your directional stuff will be negative. If you're trying to grow your account quickly, you'll probably have a flat theta because you're trying the directional stuff to give you returns. If you are focused on income, it will be as positive as you feel comfortable with. And then Vega, you get your negatives out of your credit spreads, your positives out of your long shorts. And then I always try, if the trend is up, to be slightly negative, and if the trend is down. So if the linear regression is pointing down, I will try to get into a position where my Vega is not very negative, because that's how you're, in Thinkorswim I call it the white line. It's the big curve line. How that sinks, where you start losing money, is when volatility's spiking. And you say, hey, I clicked through this first profile last week and it didn't look like it was going to be that low. Well, that's because your Vega was off. So we'll go over that another time. but that's, kind of another webinar we can get into.
Okay. That sounds great. And for anyone who may have, not followed that, we can go into, greater depth in the next session, which will be next week.